All right. Good morning, everybody. So we had some shenanigans into the close yesterday, but that all seems to be unwound, plus a little bit. We're going to get some data today, the Empire Manufacturing Survey. It is just a survey, though. Never really put a lot of weight into those. But the market is hungry for any information at all. So with the wide number that's coming into it, it's worth keeping your eye on that one. We are green on the screen with the small caps leading the way up nearly 1%. I'm curious to see if we're going to see the typical small cap behavior, which is where it leads in the pre-market, then we get into regular trading and it takes a back seat as some of the bigger dogs get to chasing. Hong Kong a flat. Japan also up near 1%. This number is what I was referring to. The previous was minus 8.7, and the forecast is 0.5. That's a wide discrepancy there. And so that can cause a little bit of chaos. I thought I saw something about Powell having another speech, but I'm not seeing it here. I guess not. Once we get through with this, I mean, the other one's the beige book, but I don't think we're expecting anything out of the beige book, surprises or otherwise. Analysts expecting beige book to largely reinforce the ongoing, quote, soft landing narrative based on reports from the 12 regional Fed districts collected in early October. Moderate expansion across most districts, continued cooling in goods and prices. Labor market is stable overall, and a dovish tilt is widely expected in policy tone and market implications. Eh. It'll be more about the language that they use rather than the numbers they present. Oh, you know what? While we're here, um, whenever we have a short week, it throws off crude, right? And even though the short week was in bonds rather than across the board, I didn't see crude in there today, which means we're likely to get it tomorrow. There's gas. Did I just not see it? All right, there it is. So we'll get, looks like we're going to get crude tomorrow at 2 o'clock. It's really odd. I wasn't expecting that. But either way, we're not getting it today. And that's kind of the point. That's a sneaky one Just like how this is the one holiday of the year where it's kind of flipped and we didn't have bonds, but we did have equities. So whenever you have a short week, you got to be mindful of what's going to happen to crude. And then, whether the short week was that we're missing a Monday or that we're missing a Friday or something in the middle, because that will affect what happens to crude or where it ends up. So late tomorrow, we'll take it. It's not like we really have a choice. So it looks like Morgan Stanley just knocked it out of the ballpark. Mentioned this gold CTA chart a while back when they were just starting this run back up. And at the time I mentioned we got these previous highs. So that's what we're looking to see. And even though we were getting really excited in gold, the point was CTAs were not positioned back to their previous allocation and that they had plenty of room. Now we're digesting a little bit here, but it's not uncommon to see that even on the way down where they paused and then continued the move down, or in previous attempts to run to the upside where they pause a little bit before continuing to make that upside move. So yeah, we're paused here a little bit. That doesn't mean that they're done and they've already established a nice little range. We don't want to see that range broke unless it's breaking to the upside, and then, match them out across the top. So if we was looking for anything that said, GTFO on the gold positions, this is stay in it. But that's just one data point, right? I wouldn't use that as the sole basis on whether or not to stay in my gold positions. As for silver, it is, I don't know what you want to call that. Looks like a chewed up piece of bubble gum. And it's not following the continued breakout. You can see the white line is silver, and it consolidated a little bit. Then it broke out of that squeeze to the upside, but CTA positioning did not. We are still above this previous breakout level, and so far they are not liquidating in size. I heard the military is going to deploy their portable nuclear energy systems onto their military bases here in the US, and they're going to collaborate with civilian nuclear engineers to provide energy for their bases that can't keep up. Bases are having power outages and loss of critical systems due to a lack of energy. I don't know what to think of that yet. This is the dealer hedging requirement, like dealer gamma. I got a write up coming on this. I'll post it in the chat in a little while. I just got to finish it up. This is the zero line down here. So we are looking to move into positive territory, but it's red. So keep that in mind. It's going to be a fight if we can get it at all. The call and put wall, the call didn't move. The put wall moved just such a fractional amount. I didn't share the new updated lines on where it went. It was back to the previous low. So I always share the image of the lines and levels, the combo, large gamma, volatility trigger. The put wall is 65.47, and it was 65.47. So no big deal, right? No big change. Or I should say that's where it is now. I already updated it. The previous days will show you what it was yesterday. It was a very small move. Otherwise, there's the zero gamma line, 66.52. We are back above the 3-week moving average. The 3, the 10, and the 20 are all clustered right underneath us at the 67.11 cog line, and we are inside day breakout of the previous day's range. Now that holds weight. We got the breakout, we need to keep it. If you look at things on the monthly, everything's still really good, right? There's nothing wrong with this. We're holding against the previous month's high. We recovered off of that 65.63 bounce and came right back up again with strength. If that's what the daily chart looked like, you wouldn't even be considering shorts, right? And that's the whole point of looking at this. That doesn't look bearish, not even a little bit. And I have people continuing to ask, hey, where's all those short positions you said you were going to open? I didn't open them. We never had anything worth building out for a longer term short position. Now, I've had shorts on because I run a beta weighted portfolio, so I'm constantly running longs and shorts at the same time. But I didn't build out a longer term January, February short position in a lot of different things because we just don't have short signals to tell us to do it. Even the Google short that I was in is already closed, and it looks like we're going to get a run in Google back up for earnings, or it just stalls into earnings, one or the other. It's kind of looking really good for an iron condor play, really, other than you got to jump the earnings for the options. So we're still stuck inside of that massive Friday candle. That's no surprise, right? A little bit of Captain Obvious. It was Friday's level, but it was also the entire week's range. So it continues to be what we're focused on. And we're back above the mid. $66.75. That's what we need to keep now, right? It's been a little shaky, but we're holding it. And the goal is to get back up to that previous level there, that last week's open. $67.80, basically. The concern is a liquidity gap. It's not the same as a price action gap because you don't see a gap in price. It was the start of this tumble. 6802. You might as well just call that 6,800, big round number. Or since we did digest here a little bit and then we fell, you could use the start of this candle, and that's 67.92 cog line. I kind of like that one better, since we worked on all of this until around 11 o'clock and then we fell out. I think I like the cog line better. So the concern is that we keep running up here from 67.28 into 67.92 cog line, and then that's it. We were all talking about that crazy drop yesterday afternoon over cooking oil. You can't see that stuff coming, right? But look at what it dropped down into. It went right to VWAP. You got to love that stuff. It's why, you continue to argue, when you start to get the move, you've already got the destination. Where's it going? To VWAP. Now, whether or not it overshoots VWAP and continues to go lower beyond that, well, you don't know until you get there. But that's the target when you start to fall. And there was a lot of warning that something was up, because we were running in this really tight range, and it started to get tighter and tighter and tighter and tighter. Well, what do you think's going to happen? That's compression. Now, it doesn't signal direction necessarily, but it is a significant warning that we're tightening up, that we can't stay here. That's the phrase I usually use. I don't care where you go, you just can't stay here. And then we finally GTFO and go somewhere. We were holding on that 10-day moving average. That's what that blue line is right there. So we got above it, we were holding it. The range just got tighter and tighter, and then down we went. So couldn't have predicted it, but there was a lot of warnings that something was off, and to get the heck out of your positions and wait for something, for a signal. Of course, it was also a really boring afternoon until that drop. We're still elevated. 87 isn't the 200 and the 178, but it's still high compared to what we normally would see, since normally, we're running below 70 or 75. So it's still a little high, but nothing compared to these last 2 days. Okay. So what we're looking at here, since we had all of that elevated volume, is a question on the open interest. This is the open interest change over the last few days. All right, we are at the ADR half. We're actually above it, and that provides a little bit of assistance. Now that we're above it, we need to keep it. Otherwise, we can get to the other side by the end of the day. Just to remind you guys, that was the discussion yesterday, right? That we had got to the ADR early enough in the day that we could get to the other one by the end of the day. And it's possible to go from the low to the high and back to the low again in the same day. But it just highlights how much violence we have right now, because you can't do that in a regular trading environment, right? If you don't have the volatility, you can't get that sort of movement. So that's what we talked about yesterday, is we could make the trip. We can make the trip again today because we're still in a violent environment. There's no reason to think we're going to make that trip. And if we did go down here on its own, that wouldn't be bearish. I know it might seem like it because we'd be going down, but it's just the way price moves in a wave, right? We got to make those moves. Otherwise, it's just a single shot in one direction, and that's when markets freak out. So we need the pullback as the part of being a healthy price. And as long as it stays higher than the previous low, then we're just setting higher lows. We've already got our higher high, and that's good and healthy. But the base case argument is that we don't get below this low established from the drop yesterday, that VWAP bounce, and that it's likely this becomes our trading range today. I guess we'll just have to see how the market responds to the data we get and if it cares at all about that data. Normally, I wouldn't pay any attention to the beige book, but with the lack of data we've got on everything else, the market's so hungry for any data at all that it's likely to grab at straws. This really ran up like it was trying to gap close off of this drop, and it did a really good job when it got there. It looked like an evening star reversal. It really felt like that was going to be it, but it didn't, and it's still up there. So I don't know what we're doing now. Even that reversal here didn't work, and we're still up there. So far today, we have a missed daily pivot that can change at any time. All we have to do is go down and hit 66.66. But if we don't hit it, then it will become a missed daily pivot. On its own, that doesn't really have too much context. I mean, we had a missed daily pivot on Monday, and we ended up whacking it Tuesday during the kill zone. But if we make it through the whole day without hitting it, that'll be the first count. And then we look for consecutive missed daily pivots. Price opened above that pivot. That's bullish. This day's pivot is lower than yesterday's pivot. That's bearish. It kind of cancels each other out. Both of them are above the weekly pivot, and so is price. That puts us in a mildly bullish posture. And we're holding an inside day breakout, and that gives us a little bit of a bullish bias as well. But we need to keep it. The concern right now is the S&R levels. If we continue to drive to the upside, we've got the ADRs overhead, but we've also got the pivots. There we go. 67.40 and then 67.96. We can get an R1S2. I don't really want to see an R1S2, but that's the strategy, right? That if you get to R1, like we did yesterday, we got to R1. It's where we topped out. And then back to the floor pivot. Now that was an S2 R1. Kind of went in reverse. R1, S2, kind of get the idea, right? And we're in a violent enough environment that that's what we can do today. So that's not my base case. The base case is that we hold the line, we close above the pivot point today, and that we really don't go anywhere other than maybe we get up here and we close this liquidity gap, that 67.92 cog line. But if we break this pivot point, the target is 66.32 cog line, the weekly pivot, and then S1, 66.11 cog line. We get below that, break yesterday's low, and target S2, which is Friday's low. It all lines up, right? So you got your target. It doesn't matter if you're bullish on the day or bearish on the day. You can change your bias, right? We can start out bullish, get new information, swap to bearish, do what we got to do. I don't like shorting from the hole. I'd rather short off the highs, but play what you got. If we get underneath this pivot, this is where we're going. We get underneath that, then we got this level, that level, and then this level down here. One at a time, right? All right, we're going to start getting into this distribution from last week. It may be more difficult once we get into that to continue to move to the upside. I know that's what a lot of options analysts are talking about. There's so much structure overhead that we could have a hard time even getting through it. So 67.42 is an old cog line that I don't mark anymore, but it's still a line that I continue to keep my eye on. And it's really close to the bottom of that box that I just drew. We're at 67.32 cog line right now. So if we can get above it, we'll aim for 50, and that'll put us in the box. Otherwise, we got a really nice distribution on the week. $66.92 cog line is the current point of control. You got to love those cog lines, man. They just keep coming back again and again. $10-day, 30-minute volume profile and TPO. The TPO looks a lot better, but really they're both, kind of chunky and broken. At least they line up on the point of control, and the value area isn't far apart. We've built out this lower structure relatively well. I think it's obvious this is where the new point of control is going to go when it does move, but we're not expecting to see it move anytime soon. And if we continue this drive to the upside, get above 67.50, then we can get back into this previous point of control, and that's going to allow us to put more footprints up there. And it might keep it up there a little bit longer. That is also now considered a significant line of defense that we've got to work through. We can call them a lot of different things: trapped traders, unfinished business. But we don't know how much work is up there. I would anticipate a lot. So, calling that resistance is probably a pretty easy thing at this point. No new VPOC from yesterday. It is interesting to note we built it up by hanging out up there yesterday. That's not a surprise. And you can see all the work that was coming in, these different levels. And this morning, we've got a little bit of a discrepancy between the volume profile and the TPO profile. This has the point of control down here below 6,700, and this one has the point of control up here, 67.25. So we want to see this TPO point of control move up, and it seems like it's close. Not quite there yet, but I would anticipate it's going to happen soon. Otherwise, we're getting that same distribution that we got yesterday. This kind of stair-stepping pause, expand, pause, building out structure. This is a more granular version of what typically happens with price anyways, right? And it's healthy because we're building a floor underneath us before we leg up into another level. And then we pause there, we build out structure, and then we leg up from there. Rather than, building a house with toothpicks. All right, we're broke out on the week. $66.92 was the top of the weekly expected move. In violent market environments, we can move the entire expected move again. So the easiest way to measure that is just go from the central point to one edge and then just drag that box up. I mean, you could get the calculator out, and act like a Canadian engineer, but this gets it done, right? It's close enough. And visually speaking, it's just a bit higher than that high of last week, which makes sense because when you get to a previous resistance level, a lot of times you overshoot it and then you fail and you come back in again. 68.11 cog line, overshoot that. We could get into 68.50 if we get really frisky, but at this point, why would we? We'd have to get some data that we don't have at this point. Maybe news on the end of this government shutdown could do it. I don't know, something really big like that could give us some fuel. We are more than 2% above the 10-week. That's not overbought. It's not overextended. We have not moved too far too fast, so it does not owe us a pullback on the weekly time frame. And we are back above the 10-day. Not much, but a little more than a quarter. Also showing that we're not overbought, we're not overextended, we haven't moved too far, and it doesn't owe us a pullback. Looking at what's down today, the VIX is down 7%, and yet it's still up almost 18% in a 5-day period. That thing was up more than 25%. The Mag 7 down volume is down. It's a double negative. It's fun. Bitcoin is down. And really, that's all we got for the downside. Lots of stuff in the middle that isn't up or down enough to meet our qualifications. Then we've got chips, uranium, China. Mag 7 up volume is up. More chips, quantum, miners, China, and China again, and then gold, and then more China. Precious metals, IPO, the small caps, tech, generic, solar, finance. This is everything you need for a rally day, right? If you're looking for the controls that you need to get to see a breakout and rally, that's the controls. That's the things you would want to see. The Mag 7 alone can do it all by itself. Don't even need anything else. You start bringing in things like consumer discretionary or financials, and you could get a really good rally day. So once we get into the open, we want to see that we continue to keep those chips. Chip names are really good for rallies. Otherwise, you want to see the Mag 7 holding up. You can use the MAGs, the ETF, or the NY FANG if you like that one better. And as long as we don't get any pushback from dollar, treasury, and commodities, then we should be good. So with the dollar, it's not necessarily seeing the dollar go up or go down, although down is what we want. It's how fast it's moving. We don't want to see big, crazy moves here. So a gentle fade in the dollar back towards 98. Let's get there and see if we can digest that, continue lower. The goal would be back down into this 97 area eventually, not in one day, hopefully. And the same with the 10-year. Up or down doesn't really matter. I mean, I'd rather see it go up than down, but no big moves is the key. Just nice and easy. Breaking below 4.0 and getting into this 3.9, anything below 4, I think isn't going to help us out at all. And gold continues to just be a textbook case. So until it breaks, you know, run it. I think you'll know when it breaks. It'll look a lot like the ES did on Friday, where everybody's chasing the exit and they are hitting below the bid in a panic. That's the only way I would short gold, is if I see them panic selling. So 67.50, 67.92, and if we overshoot that, we can get into 6800 and to 6811 cog line. If we get back inside of yesterday's range, then the goal is to get back to that drop we had into the close, and then yesterday's low, then Friday's low. There's a little bit in between here. The ADRs and the SNR levels will fill that to kind of give you a level somewhere in the middle here. So it's not such a big drop. There's a cog line right there, right? 32 cog. That way the distance from each target isn't so big. Short, sweet, easy, and simple, right? That's what I got for you guys. Be careful, be safe, make some money. I'll see y'all tomorrow.